Underwriting for the Money Doctor Show is provided by Regari Real Estate, Federal Street, Greenfield, a third-generation real estate agency serving the Pioneer Valley. Ryan and Casey Liquors, Main Street, Greenfield, exploring the world one glass at a time. West County Equipment Rental of Shelburne, daily, weekly, monthly rentals, 625-6463, or on the web at westcountyequipment.com. The Franklin County Community Development Corporation, growing sustainable businesses and communities since 1979. www.fccdc.org. Weld Communications, Marketing and Publicity, helping businesses spread the word in the Pioneer Valley and beyond. www.weldwords.com.
There's a better life if I could be debt-free, but all my money is a mystery. I was feeling overwhelmed and it was wearing thin when I knocked on the door and heard the doctor's in. Oh, the doctor's in, the doctor's in. She got the right prescription to help you win. Oh, the doctor's in, the money doctor's in.
Hello and welcome to the Money Doctor Show. I'm Dr. Frances Rahaim, president of Power Down Debt, and my guest today is Peg McDonough, a reverse mortgage specialist. Now, let me paint a little bit of picture for you. First of all, thank you for doing this, Peg.
Thank you, Frances.
My pleasure. Here's a picture. You're 62 years old, not you, my imaginary friend here, 62 years old, living on a fixed income perhaps. The income is fixed, the expenses are not.
That's right.
And now they may be forced to live on credit cards or other spending down their savings or whatever the case is, sometimes just to handle uncovered medical expenses, prescriptions, co-pays, or other kinds of expenses that just didn't stay in line with their fixed income. So very often, let's say somebody recommends a reverse mortgage as a solution, but they're not sure what a reverse mortgage is or how to go about watching out for the pitfalls, who to trust, what's a good reverse mortgage, what's a bad reverse mortgage, all of the ins and outs. And that can be a really scary place for people to be. So even though it sounds like an immediate, instant solution, there are some things that we want to watch out for. And this show obviously is a lot about sort of blowing the lid off of things people don't tell the general public that I feel they should know, which is why I asked you to come, and I thank you so much. And I should say, you've been a reverse mortgage specialist now for about 9 years. It's all you do. You breathe it day in, day out. You're working from the Holyoke area all the way up through our area easily, and you're up here often. And I've come to know you over the years as somebody that I could trust as a straight shooter, who will do the right job for somebody when they ask for a reverse mortgage.
Well, thank you, Frances. That's very flattering. I hope I am a straight shooter. As you say, I am a straight shooter. While I think the reverse mortgage is a very, very useful tool for homeowners, it is not for everybody. So it's very important that the need of the client, the borrower, match what the reverse mortgage can do for them.
Sure.
I think the best place for us to start to talk to your viewers is to explain what a reverse mortgage is.
That's exactly what I was just going to ask. People hear that reverse mortgage, it doesn't even seem logical. It's certainly counterintuitive in thought. So please explain.
Sure. A reverse mortgage simply is a home equity loan that pays a borrower a portion of their home's value in cash.
Okay, wait, womp, 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 womp. I got that Charlie Brown thing. Okay, if you have equity in your house,
right,
there's a way for you to access it. And instead of making a mortgage payment out and increasing your payments outwardly, you're actually getting an income in from it.
That's right.
Okay, got it.
It's called a reverse mortgage because instead of the bank lending you money, well, we are doing that, but we're going to wait to be repaid.
Okay.
So in other words, you can access, again, a portion of your home's value,
right,
your home equity, in cash, use the money for any purpose, and not worry about taking on a monthly payment to the bank as long as you live in the house.
Okay, so when you say we're going to wait to be repaid, you're going to wait to be repaid until someone is not living in that house, until that person who took out the reverse mortgage is no longer living in the house.
Right.
Now, I'm probably getting the cart ahead of the horse, but that could be that they're now in a nursing home,
Right.
It doesn't mean that they're deceased.
Correct.
Or
It can
that
be,
they've sold the house.
That's right. You can either decide, well, it's time for me to sell. You can, unfortunately, you sometimes have to go to a nursing home, in which case that would be time for us to be repaid. Or simply you pass away, and at that point your estate or your family would sell the home, typically, and pay the loan back.
Right. Sooner or later, the bank has to be paid back.
Correct.
There's no doubt about that. You brought up an interesting point, and boy, I'm so glad you do this all day, because what would happen if somebody went into a nursing home for a short period of time? In other words, they, for instance, had a hip replacement, and now they're into a nursing home for rehab. Is there a period of time in which that loan can stay afloat?
Yep.
Or how would that work? Would they just notify the bank?
Well, for a short-term rehab, they really don't have to do anything.
Okay.
The loan is in place. If with a person with failing health finds that they have to be in the nursing home, probably for good, at that point they would notify the lender.
Okay.
But you're allowed to be in a nursing home for up to 12 full months before the loan has to be repaid. So for a short-term situation, there would be no effect.
Right. So really important to know. Now, one of the things that I mention to people in dealing with finance when there's a possibility that a reverse mortgage might be, boy, we overlap so much here. When there's a possibility that a reverse mortgage might be the right solution for them, first of all is to find a specialist that they can trust, so on and so forth. But secondly, that they might wish to involve family members in this. The place that I see reverse mortgages go awry is that parents take them out on a house. They're too ashamed or too embarrassed to tell their children that they needed financial help because they were afraid their children would try to fix it for them. And so they take a reverse mortgage out and they don't tell the beneficiaries, they don't tell the kids. Now the parents pass away, the loan is due, the kids think they're inheriting a house that has all this equity in it, and it turns out that it may have been tapped off, and now they tapped out, and now they have a loan to repay. So I usually will recommend that they at least tell their children that they're doing it or that they've done it. Do you find that to be a problem sometimes, or?
Usually, I agree with you. We do encourage our borrowers to involve their children or those that they feel it's important know about the loan, particularly the heirs for their estate.
Sure.
I did want to correct one thing that you said.
Bring it on.
Generally, the borrower or borrowers, in the case of a husband and wife, are the ones that are quote unquote liable for the debt. It's a transaction between themselves and the lender.
Right.
The children, even after the parents have moved out of the home or passed away, the children or the heirs are not themselves liable for the debt.
Right.
There is no personal recourse with a reverse mortgage.
Sure, but it's still against the house. The debt is against the house.
It is against the house.
And that's where I think the problem comes in.
Yes, and we do, again, encourage borrowers to involve their children ahead of time so that everybody's on board with the transaction and that there are no unpleasant surprises.
Sure. But let me say that even though I recommend to people, you know, involve your children, I'm a fan of it's your money, it's your decision, you make the decision. You want to tell your children you're doing it, you want to ask their opinions, that's fine. But in a case where it might really be your best solution and you're thinking this is the right thing to do, and your children for some reason tell you, it's okay, don't worry, we'll take care of you, you need to be responsible and make your own decision. If it's against your children's wishes, then so be it, but it's still your money and your house.
That's absolutely right. While we do encourage, again, the kids to be involved, it is ultimately the homeowner's decision.
Right.
And if this loan will solve their financial problem, then it is their decision to move ahead.
Okay. So let's clear up a couple of little myths, at least. We'll talk more about this in the second half of the show, too. But there are lots of myths about reverse mortgages, like whether the proceeds are going to be tax-free or not, or does who takes possession of the property. So what can you tell us about that? Give us a short and skinny
I'd say
on it.
the number one myth about reverse mortgages is that the lender takes the house. The lender does not take title to the house. This is simply a mortgage transaction, like any other. The lender is lending money to a borrower, and then at some point in the future, the loan will be repaid. The home is used as collateral for that loan. So, but the lender does not take title. It's still in the borrower's name. They still have to pay their real estate taxes, their homeowner's insurance, and make repairs.
So people who do estate planning would recognize the language you just said to be very similar to a life estate. which is a completely different process, where you gift your home to your children or to whoever or whomever, and then in return you keep the right to live in that house your entire life, but you are responsible for the taxes and the insurance, et cetera, et cetera. This is not that. And it's also not a regular home equity line. Like somebody would say, well, why don't I just take out a home equity loan and I'll just take the cash from that and I'll live off of it.
Well, I'll tell you the difference.
Thank you.
It is actually an equity loan, but the difference is we don't expect repayment as long as the borrower lives in the home.
Right.
So it's called a reverse mortgage because since you're not making a payment to the lender to pay down the debt is actually rising over time.
Right.
It's going in reverse.
Right.
And so that's really the major difference. You can have an equity line of credit with this loan where it's there if you need it. You borrow it as you need it and when you need it in any amount. But again, it requires no repayment. Some people who are on a fixed income cannot afford to take on an equity loan. They can't afford, very simply, to take on more payments.
Right. Even a small interest payment is sometimes too much for them to do.
That's right.
Right. Certainly, we want to talk more about the idea of a home equity loan in this context, because I think that's a great thing. You could go through the process. It's my understanding you could go through the process of finding out if you qualify for this sort of loan, if it's a good fit for you, all of that, and still not take the proceeds right away. Just take them as you need them. Right. And so that might be a nice safety net for people to have.
Right, a cushion.
Yeah, a cushion, exactly.
It's there if you need it, but you're under no obligation to spend all of the money that's made available to you.
Right.
And the way we determine how much you can borrow is we have the home appraised, and based on the age of the borrower, and the interest rate for the loan that's selected determines what proportion of the home value is lent to the borrower. Generally speaking, the older you are, the more you can borrow.
Right. Because it's based on life expectancy tables, I would assume.
That's right.
Right. So if the government says you have, according to their tables, you have 10 more years to live, then you're going to get a higher amount of equity that you could borrow out of your home than if you had 20 more years to live.
Well, to reassure your viewers, we calculate from the present age of the borrowers to the age of 100.
Oh,
and we
I like that better.
That they're going to live a nice long life.
Yep.
And so we make the money available to them based on that life expectancy.
Well, what I like about that, people out there might be saying, well, that means I get less money. What I like about that is it's safe. Right. It's much safer. I mean, most people are not living to be more than 100.
That's right, and it is safe for another reason. As you know, the reverse mortgages that I lend are FHA insured. They're insured by the federal government.
Yes.
In other words, they have the full faith and backing of the federal government. And that government insurance does two things. It ensures that a borrower can never owe more than their home is worth.
Right.
And it also ensures that if the lender went out of business, which sometimes happens, that the federal government would actually step in and become the lender for any borrower. So they're totally protected. Their money is not going to disappear.
Right, right. Well, I certainly like all of that. And when we get back, when we come back in a moment, we're going to talk a little bit more about FHA insurance and what role that plays, different kinds of reverse mortgages, because it's not just a cookie cutter, one fits all.
That's right.
And consumer protection laws, things like that are out there to protect people, because we are dealing in a senior market. Not that younger people don't need to be protected too, but there are a lot of predators in a senior market. It's been my experience over 25 years in finance. So I want to make sure that we talk about what sort of safety features are out there and what people can do to make sure that they're getting a good reverse mortgage if in fact it's a fix for them.
Okay.
So when we come back.
Underwriting for the Money Doctor Show is provided by Regari Real Estate, Federal Street, Greenfield, a third-generation real estate agency serving the Pioneer Valley. Ryan and Casey Liquors, Main Street, Greenfield. Exploring the world, one glass at a time. West County Equipment Rental of Shelburne. Daily, weekly, monthly rentals. 625-6463 or on the web at westcountyequipment.com. The Franklin County Community Development Corporation. Growing sustainable businesses and communities since 1979. www.fccdc.org. Weld Communications, Marketing and Publicity. Helping businesses spread the word in the Pioneer Valley and beyond. www.weldwords.com.
Welcome back to the Money Doctor Show. I'm Dr. Frances Rahaim, president of Power Down Debt Incorporated. My guest today is Peg McDonough, who is a reverse mortgage specialist. Welcome back, Peg.
Thank you, Frances.
Thanks. Okay, so we've gone all over, what a reverse mortgage really is, how it might work for some people. There's still a lot of uncovered territory. So a couple of things that I said we'd talk about when we came back after the break is FHA insurance, some consumer protection laws and how that might work for people to protect them, and different types of reverse mortgages. And also, before we're done with the show, I want to get some of the stories from you, because you have some great stories about both young and older people who have used this. And we may not fit this all in one show, but we're going to try. So tell me about FHA insurance.
Okay. A very important thing for people to know is that the reverse mortgages are insured by the federal government, by the FHA.
Okay.
Which means that the lender the borrower buys an insurance policy when they're purchasing or when they're signing up for the loan. The FHA then backs the loan and protects them in the event of lender default.
Okay, so in simple terms, part of them buying this reverse mortgage is that the government says, even if the company you bought the reverse mortgage from goes belly up, I told you it was layman's terms,
yep.
Even if they go belly up, we're going to ensure that you get your money every month, or
that's right.
That you get the bulk sum of money, whatever kind of loan you've
That's
taken.
correct. So
that's a good thing.
That's right. And then the other thing that the FHA mortgage, the insurance does protect people is that if at the end of the loan, because it is a rising debt loan, mm-hmm. At the end of the loan, if you end up owing the lender more than your house is actually worth,
right,
your debt is settled no matter what the house sells for.
Okay.
Because of that FHA insurance.
And when you say it's settled, you don't mean like settlement like these credit card companies are doing where it harms your credit. You just mean they give up the rest of the, by contract, they give up the rest of whatever is owed on the house.
Right.
And say you just don't owe it anymore.
In other
Your
words,
heirs don't owe it. Nobody owes it. It's gone.
That's right.
Okay.
In other words, if you owed the lender $150,000 because
right.
you lived a good long life, you spent all that was made available to you,
right.
and the interest on those monies built up to the point where you actually owed more than the house is worth.
Right.
If your house sells for, say, $150, but you owe the lender $175, mm-hmm. your debt is settled no matter what.
Right. Now that is hugely important. To get off of reverse mortgages just for a second and paint a little picture back to the burst of the bubble, whether you think it's 2008, 2007, the real estate bubble, part of what I thought was the problem is that money was very, very cheap for banks to lend. I mean, they were getting these ridiculously low prime rates. So they got very aggressive about lending to people who had even mediocre credit. There were these no document loans, low document loans where you hardly had to provide anything to get a mortgage. And to make matters worse, they were lending up to 125% of the value of your home. So if your home was worth $100,000 at that time, you could borrow $125,000 against it under the pretense that our houses were exponentially increasing in value. Well, needless to say, many people did this in two mortgages, a first mortgage and then a second mortgage to bring them up to that level. What has happened now in many cases is that was so much more, the loans were so much more was owed than the value of the house, excuse me. There was so much more owed than the balance of the house, or the value of the house, that when they went to refinance that second mortgage, perhaps it was a balloon payment that was due in full at the end, they couldn't do it. There wasn't enough value in the house. Or if they couldn't afford to make these payments, many homes have fallen into foreclosure, even based on the second mortgage, which might have been a small amount of money, but there's not enough equity in the house to lend. So that was a complicated way around saying, I think it's bad for people to be able to borrow more than the house is worth in a safe market.
I agree with you.
And right now we're in a safe market.
That's right. Right now, well, with a reverse mortgage,
for a reverse mortgage, I should say.
We don't lend 100% of the home's value. We only lend a portion,
right.
Again, based on the borrower's age
right.
and life expectancy.
And we have to give room for that to increase because you're not making payments against this loan, so that is sort of stacking up on top of the loan.
Exactly.
That's why you said it's a rising interest loan.
The interest will be added to the debt balance over time,
right.
and so the debt actually grows. Again,
sure.
It's a reverse mortgage. In the example you gave before about people being lent too much money, I have been able to assist borrowers who do have, say, an equity loan that had a variable rate that all of a sudden went up kind of overnight, and they weren't able to meet the payments. So, and they are typically, my borrowers again are over the age of 62, so many of them are retired, and therefore don't, if a payment goes up suddenly, they have no wherewithal to come up with the extra money because
they're not going to work some overtime that week.
Right. Or they're going to have to cut back somewhere else. And really, that's the scary part. So I have been able to refinance people's homes with a reverse mortgage who are in that situation and be able to get rid of that payment completely.
Wow.
The equity loan payment or the mortgage payment completely. Because that's a requirement of these loans. If you take a reverse mortgage and you have an existing mortgage or equity loan, it must be paid off out of the reverse mortgage proceeds, so that the reverse mortgage is the only loan you're able to have.
Right. Well, that makes sense for sure. Different types of reverse mortgages. How many different types of reverse mortgages are there, and how? I mean, I don't know how detailed we need to be, but there's lots of, 25 years ago, you and I were talking off camera, about 25 years ago, reverse mortgages were around. They were just very simple and maybe not so great a product. Today, there's all kinds of uses, and we probably won't talk about this in this show, but even the use for someone younger to maybe use it to buy another house, or someone older to use it to downsize and buy another house. But how many different types of reverse mortgages?
Well, there's really two types. There are standard reverse mortgages, which are the loan that pays you a portion of your home value and you use the money to live on and pay it back when you've decided to sell the home.
Okay.
We have both fixed and variable rate reverse mortgages.
Right.
And we also have a fairly new reverse mortgage called the HECM for purchase, where you can actually use a reverse mortgage to purchase a home.
See, now I think that's like, heck, I'm out of money. I need to buy a house. What am I going to do? HECM, H-E-C-O-M?
H-E-C-M.
H-E-C-M.
It stands for Home Equity Conversion Mortgage, because you're converting your home equity into cash to live on.
Sure.
And the HECM for purchase is kind of a specialized product in that it would help a person downsize to a smaller home that's more appropriate for retirement living.
Boy, is that a common situation. I mean, how many people feel trapped in their home? It's a large home, whatever the case is. They need to downsize, or they're going from 2 or 3 floors down to 1 floor, and they have equity in their house, but how do they get from point A to point B?
That's right. So this is kind of a new product. The baby boomers are loving it. There's a lot of interest.
Sure.
But the standard HECM is really the one that is the most popular. And again, that's for the homeowner who wants to live in their home, really has nowhere they want to go. They want to be near to their kids. They want to be able to afford to stay in the home they've lived in typically for 40 or 50 years.
Sure.
So those are the folks that I most often work with. And that's the loan that will keep them comfortable, give them a cushion, kind of the rainy day fund, so that when the tax bill comes in or a sudden repair comes up, they can comfortably pay for it.
Sure.
And not have to worry about, am I going to be able to pay the oil bill?
Isn't it nice that you do something that you can feel good about at the end of the day?
Absolutely. I think that's the reason I specialize in these loans, because I know when they're used appropriately, they really help people.
Yeah. Would you share some stories with us about maybe somebody younger, maybe somebody older, but favorite stories of people who you think you've helped doing reverse mortgages? Okay.
The first time I think I really realized how important these loans can be to people was years ago when I first started. One of my first customers was a woman, a husband and wife, and the husband had cancer. But he was in remission, and they were kind of coming up for air from all the stress of going to the doctor and so on. And the woman was reluctant to speak to me. She was encouraged to do so by a good friend of hers who actually had a reverse mortgage. And so she finally sat down with me, and we talked, and I said, well, what's going on? And she explained about her husband being ill, and then she started talking about how difficult it was to make ends meet, because they had to use some of their money for medication and for, just a lot of different things. And she burst into tears.
Yeah, well, emotionally, she's completely maxed.
And, I was so green and so new at this. I literally, I got upset. I was like, oh no, handed her a tissue and held her
Yes,
hand, and I just said, just tell me what's going on.
Right.
And she talked and talked and talked, and she really was crying pretty hard.
Yes.
And I assured her that, you know, I said, I think this is really, sounds like this might be for you. And she ended up having credit card debt that was run up because she had to use the credit card to buy medication.
Right.
And so we were able to, first we talked to her kids, and they would say, definitely do it, Mom.
Right.
And we signed them up, and she was able to get rid of all the credit card debt. She had money to fix some of the repairs in the house that had been let go because she simply could not afford. And it was able to give she and her husband that breathing time after his illness that really helped them. And it was a complete success story, if I do say so myself.
Yeah. You know, a similar thing happens at Power Down Debt. When people come in to see me, they're not crying when they come in the door. I've never had anybody come in the door crying. But I had to put Kleenex in my office. In fact, I had an agent who worked with me, and she said, I'm not going to come to appointments anymore because every time I come, someone cries. And I said, Sarah, they cry all the time. It's not because you're here. But people don't cry, in my office at least, they don't cry because they're upset about the debt. They cry when they realize there's a solution. Right. And the dam breaks.
The relief.
And it's relief. And it's always the same sort of stuff. They're ashamed that they couldn't manage the money. They're embarrassed about having to go to somebody for help. They don't know which way to turn. They're emotionally maxed. I mean, completely right at the line. They got all the plates in the air. Add to that something like someone going through cancer. Oh my gosh, the last thing they want to do is share with their spouse who is ill that there's a money problem. And so they shoulder it all themselves.
And he was actually, when we had the conversation, he was all for it. He said, oh, let's do it, you know.
Sure.
And she was a little reluctant, but because she had managed. She had managed so long, she was so used to it that she didn't realize that there was such an easy solution.
Boy, I'll tell you, we're almost out of time, but do you have a favorite story, a short story about an older person that you might have helped that you felt was really worthwhile?
Very often I meet with people who are, you know, facing the end of their lives. And I had this one lady who was sharp as a tack, 95 years old, 95, in a wheelchair, living literally in 2 rooms of her downstairs because of her frailty. But her brain was still sharp, but she had care at home. She had been a nurse, so she was very into health, and she lived a long time, I swear, because of her health knowledge and just how well she managed her infirmities. And I was able to close her loan right after her 96th birthday.
Wow, that's wonderful.
And it gave her a lot of money to be able to afford the nursing care and the round-the-clock care that she needed.
And so she could stay in her home.
And she lived to be
wonderful.
100.
Wow, that's wonderful.
Yeah, so she was my favorite.
Wonderful. Peg McDonough, I hope that you'll come back for another show and we can talk a little bit more about uses for reverse mortgages. I just feel like it's a very much uncharted territory for people, and I'm happy to have you here to explain things.
Thanks, Frances. I'd love to come back anytime.
Thank you.
Thank you.
Until our next chat, let's keep it positive.
There's a better life if I could be debt-free, but all my money is a mystery. I was feeling overwhelmed and it was wearing thin when I knocked on the door and heard the doctor's in. Oh, the doctor's in, the doctor's in. She got the right prescription to help you win. Oh, the doctor's in, the money doctor's in.